Hi, this is AJ speaking. Welcome back to my Tesla 2024 financial review. This is part 7. We start right off with energy and storage, gross margins. You can see in the fourth quarter, Tesla delivered 25.2% gross margin in this business segment. This is a very strong number. However, we have to recognize there's a significant sequential decrease from the record all-time high margin that was achieved in 3Q at 30.5%. The CFO actually talked about this margin on the third quarter earnings call, and he said that this is a function of mix of projects being deployed in the quarter. So this was kind of this was code for this was an outlier margin. And then also he gave some guidance in terms of deployments. He said there will be fluctuation in margins. This was a huge hint as we managed through deployments and our inventory. So from this, you could have expected declining margins. I did forecast, because of that decline and other reasons, to be honest, declining margins. So what you have to understand is in this sector of the business, there is significant Chinese competition is growing and other competition as well. And when you look at the prices they can offer on the global market, they are significantly less than half of Tesla's. Of course, Tesla still has a software advantage, you have probably greater project certainty because Tesla has been building more of these products. There are also, especially for European or North American customers, fewer, let's call it, security concerns, because these products are full of chips. They are connected to the internet, and certain customers, just for that reason, will not buy Chinese products. But in other parts of the world, the story will be different. I expect further margin erosion because this is, let's face it, there's a commodities business, and a premium margin for that reason cannot be sustained for very long. Also, in terms of supply, Elon talked about this. Right now, Tesla is production constrained. However, on the global market, when you look at how quickly competitors can deliver his products, there is apparently significant capacity that is online and can supply customers. So all this creates going forward margin pressure most likely. The upside is that Tesla just launched the Shanghai Megapack factory. So Tesla, from that factory, out of that factory, production will be highly cost competitive, and this will then help sustain margins. Although we should not be naive, there will be significant price competition in this piece of the business. But having said all of that, I expect this part of the business will be, in terms of financial performance, will be the story of 2025. I said this before. I still believe that's the case. Yes, vehicles are launching. There's ride-hailing launch, etc. And I will discuss this all in detail in my forecast. But in terms of earnings generation, energy and storage will probably be the largest sequential driver. Because that's driven by, number one, significant volume growth. Tesla expects over 50% volume growth, and because of Tesla Shanghai, etc., margin will, even though I expect it will come down, it will still be quite attractive. And for that reason, in terms of sequential change, this will be quite attractive in 2025. So then when you look over on the right here, the navigator, where we are in a P&L, we discussed now the main components. I skip over service and other because it's a lower margin business, smaller, so not a key gross profit driver. So now when we jump right to GAAP gross margin, you can see it came down quite a bit. So this GAAP gross margin includes everything, auto, energy, service, and other. Credits everything we already discussed, and you can see that in 3Q we were just under 20% at 90.8%, and then we saw this significant sequential margin decrease, which was driven basically by all segments: auto, energy, and service, and other. All these business saw margin erosion. So if we just focus on what's the interim result of this review, so gross profit came down, despite some growth in revenue, and ultimately this mathematically had to end up in a significant margin erosion. But this is only one part of a three-part story in the fourth quarter, and now we talk about the second part. The second part is the cost story. Here you can see operating expenses, and high level how you can think about a business's financials is you can think about it: gross profit number one, operating expenses number two, and then other. And other in this quarter was quite important to Tesla. So if we focus now on operating expenses, so first of all, operating expenses, what is it? It comprises R&D expenses and SG&A expenses, sometimes loosely referred to as kind of overhead expenses. Not quite correct, but this is often how people talk about this stuff. Big picture is this is really sort of your cost-based, and should not be confused with production cost, COGS, often abbreviated cost of goods sold. Or cost of revenue is all basically the same term. So you can see that, and I'm sorry, the color coding is wrong. This number should be red because these are costs, and so when they increase, it should be red, should be negative. And you can see that we have seen both year on year and sequentially a significant cost increase in 4Q, and we'll get to why in a second. But you can see that after we had the 2Q headcount reduction, and by the way, these numbers include also the restructuring charges, and that's why this number is so high in 2Q, almost 3 billion. Tesla cut headcounts. This number includes a significant restructuring charge of over 600 million, and that's why we had this massive drop in operating expenses in third quarter. And now we see some unwind of these effects, and that's why I talked before. 3Q was like the perfect positive storm. A lot of things in terms of margins, etc., came together, but also the OPEX picture improved significantly. And now we have kind of a reversal also in terms of cost. So what caused the reversal in cost? Here's the first key driver, R&D expenses. And here I made the same mistake. Here this number should be red. So both sequentially and year-on-year R&D expenses increased enormously. This was actually one of the biggest drivers of my 3-cent miss. I forecasted 76 cents. Tesla delivered 73 cents in the fourth quarter, because when you look at this trend, even though Tesla was working on various products. We learned in 1Q Tesla was working on lower cost vehicles, and there were all kinds of other R&D projects ongoing. In October, third quarter, in beginning of fourth quarter, we learned we saw that this Cybercab reveal. So and all these things. I mean, you would have expected that the 1Q R&D expense would likely at least stay the same or grow. But what happened is that Tesla actually dialed R&D expenses down quite a bit, and now we saw this massive spike. So something clearly changed in Tesla's business. I think that was driven by a combination of factors. One, of course, the new Model Y, Cybercab development. Ongoing. Tesla is working on its own lithium refining, where they just recently launched first production, and then there are obviously significant spend on FSD development. Some of this R&D expense is capitalized, so this doesn't show up in this number, but the majority of it will show up in this number. So there's a lot of things ongoing. The just a curious thing about 2024 was that the R&D expense, as you can see, there was a long-term upward trend. Basically stopped, and for 2 quarters R&D expenses came down, and now we see a major reversal, a major return to R&D expense growth, and a jump to a new all-time high at almost 1.3 billion in a quarter. So this was part 7 of my multi-part series, and in the next part 8, we'll be continuing our discussion of Tesla's cost development. So see you in the next one.